10 years ago, saving money felt possible. Not easy, not fast, but possible. You put something aside each month, watched it slowly grow. Maybe it didn't make you rich, but it felt like progress, like control. Now, you can do everything right and still feel like you're falling behind. Your salary goes up, your savings go up, but somehow your future feels further away than before. That's not your imagination. Saving money is getting harder every year. And the reason isn't just inflation or rent or bad habits. It's the system itself. Right now, millions of people are experiencing the same quiet frustration. They earn more than they did 5 years ago. They save more than they used to. But their money feels weaker, like it's leaking value, like it's running on a treadmill that keeps speeding up. This matters because saving money isn't just about comfort. It's about freedom, options, time. And when saving stops working, something deeper starts to break. Because the rules you thought were reliable aren't anymore. Let's start with the simplest idea. Saving money used to mean delaying consumption. You don't spend today, so you have more tomorrow. That trade-off only works if tomorrow's money is worth at least as much as today's. For a long time, that assumption mostly held. Then something changed.
Quietly.
Gradually. Then all at once. Inflation. You already know the word. But most people misunderstand what it actually does. They think inflation just means prices go up. But that's only half the story. The other half is more uncomfortable. Your money goes down. Not physically. Numerically, it might even grow. But in terms of what it can actually buy, it shrinks. Imagine you saved 10,000. You feel responsible, disciplined. Now imagine everything you need gets 5% more expensive every year. If your savings aren't growing faster than that, you're not really saving. You're slowly losing. And here's the part that makes it worse. Even low inflation compounds. At 3% inflation, your money loses about a quarter of its purchasing power in 10 years. At 5%, it's closer to half in 15 years. So you're not just standing still, you're moving backwards.
Quietly.
Relentlessly. Now add the second layer. Interest rates. This is where things start to feel a little ironic. Because saving money used to come with a reward. You put your money in the bank and the bank paid you interest. Not a lot, but enough to matter. Enough to offset inflation, or at least soften the blow. Then, after the global financial crisis, something unusual happened. Interest rates dropped and stayed low. For years, banks paid almost nothing, sometimes less than inflation, which created a strange situation. The more responsibly you saved, the more you guaranteed your money would lose value. Meanwhile, borrowing money became cheap, very cheap. So cheap that it reshaped the entire economy. Think about it. When money is cheap to borrow, people borrow more. Companies borrow more. Governments borrow more. And when everyone has access to cheap money, they start buying things. Assets, property, stocks, anything that might go up in value. Prices rise. Not just because things are more useful, but because money is easier to get. This is where the system starts to tilt. Because if you're saving cash, you're standing still. But if you're holding assets, you're moving up. And over time, that gap becomes enormous. Here's the uncomfortable math. Let's say you save $1,000 a month. Consistently. For years. You feel disciplined, structured. Now compare that to someone who borrowed money at low interest and bought an asset that rises 8% a year. They didn't necessarily work harder. They didn't necessarily save more. They just participated in a different part of the system. And the system rewarded them differently. This is why saving feels harder. Because traditional saving is no longer aligned with how wealth actually grows. Now layer in the third force. Cost of living. This one feels obvious, but the mechanics are not. Prices don't rise evenly. They rise unevenly. And the things that matter most rise the fastest. Housing, healthcare, education, energy. These aren't optional. You can't opt out of rent. You can't negotiate with inflation at the grocery store. So even if your overall inflation rate looks manageable on paper, your personal inflation might be much higher, which means your ability to save gets squeezed from both sides. Your money is losing value, and your expenses are rising faster than average. Now here's where it gets even more subtle. Wages. People assume wages should rise with inflation. Sometimes they do, but rarely in real time. There's always a lag. Prices go up first. Then maybe later wages adjust, if they adjust at all. During that gap, your purchasing power drops. And even when wages catch up, they often don't fully recover what was lost. So over time, you experience a slow erosion. Not dramatic enough to panic, but consistent enough to matter. Now step back and look at the system as a whole. Money is being created continuously through lending, spending, and policy. That money flows into the economy, but it doesn't flow evenly. It tends to reach certain places first. Financial markets, assets, large institutions. By the time it reaches everyday consumers, prices have already adjusted. This creates a kind of hidden timing advantage. Some people benefit early, others pay later. And savers? They're usually at the end of that line, holding money that's already been diluted. This is why saving feels different now. Not because saving is wrong, but because the environment around it has changed. You're playing the same strategy in a completely different game. And here's the part that rarely gets said out loud. The system doesn't necessarily want you to save. It wants you to spend, or invest, or take risk, because spending drives growth. Investment drives expansion. Debt fuels both. Saving, on the other hand, slows things down. So policies, incentives, and structures often nudge you away from saving cash. Not aggressively, not obviously, but consistently. Lower interest rates, higher asset prices, managed inflation, all small signals pointing in the same direction. So when people say, just save more, they're not wrong. But they're also not seeing the full picture, because the difficulty isn't just behavioral, it's structural. You're trying to preserve value in a system designed to move it. Now contrast this with the narrative you usually hear. Work hard, spend less than you earn, save consistently, and you'll be fine. That advice made sense in a different era, when money held its value better, when interest rates rewarded patience, when assets weren't inflated by years of cheap borrowing. Today that same advice feels incomplete, because the gap between saving and growing wealth has widened, and it keeps widening. So what does this mean going forward? If inflation remains a constant pressure, if asset prices continue to outpace wages, if money continues to expand, then saving in its simplest form becomes less effective over time. Not useless, but insufficient on its own. And that creates a new kind of tension. Because not everyone wants to take risks. Not everyone understands markets. Not everyone has access to assets. Yet the system increasingly rewards those who do. And that leads to a bigger question. Not about saving, but about fairness. If doing the responsible thing leads to falling behind, what happens to trust in the system? What happens to long-term planning? What happens to the idea that discipline alone is enough? Because right now, something subtle is happening. People are saving more, but feeling less secure. Earning more, but owning less. Trying harder, but getting further from the outcome they expected. So maybe the real question isn't, why is saving getting harder? Maybe it's this. If the rules of money have changed this much, why are we still being told to play the old game? And what happens to those who never realize the game has changed at all?